If you're a strip center owner, you might be leaving thousands, if not hundreds of thousands of dollars on the table without even realizing it. I've seen and worked with many private client owners making costly mistakes by not doing a few things, and today I'm going to cover some of these to help you avoid them. Retail real estate isn't just about collecting rent. It's about being strategic and maximizing value while minimizing risk. The difference between a more astute investor and an average owner is knowing how to position your asset for long-term success. I'm going to break down a few common mistakes that have really stood out to me lately, of which certain strip center owners made that are costing them money, and we'll address how to fix them so your investment performs at its highest level. Let's start with one of the biggest money losers I see, and that's not knowing or understanding where market rents are, and in effect having rents that are too low or too high. If your rents are too low, you're obviously leaving money on the table by signing tenants at rates below market value, reducing your income and long-term asset appreciation. On the flip side, if your rents are too high, you risk longer vacancies as prospective tenants may opt for competing centers with more reasonable or acceptable pricing. Even if you secure tenants at inflated rates, they may struggle financially, leading to higher turnover, potential business failures, or relocations when their lease expires. Both scenarios directly impact your net operating income, or NOI, ultimately reducing your property's market value and investment returns. Right now, I'm working on a 60,000 plus square foot retail center where the owner has been passively managing the property for years and hasn't been keeping up with market trends. After doing a deep dive into the rent roll and tenant leases, I found that about 60% of the tenants were on expired leases and had been operating month to month for some years now, without any rent adjustments. So well below where rent should be at and what would be acceptable for the property. Now, at first glance, the property looks fully occupied and performing well, but in reality, the stagnant cash flow has cost the owner both income and property value over time. So now I'm working on locking in strategic lease renewals with fair rent adjustments while also focusing on filling vacancies at strong competitive rates. So this is a prime example of why staying proactive with lease management is so crucial, and I'll keep you posted on the progress. If you are a landlord, you should be getting a market rent analysis at least once a year and also a BOV, or broker opinion of value, performed to understand not just value, but overall marketability and where you stand against similar and competing properties. You should also have your advisor provide lease comps and retail trends on a regular basis, like every quarter, so you can make more informed decisions with your rent roll. Also, talk with your tenants. If you can understand how they are doing and how their businesses are performing, you can also get ahead of any potential problems. Mistake number 2. Ignoring tenant mix and co-tenancy risks. Filling vacancies isn't just about getting rent checks. It's about getting the right tenants and tenant mix. In particular, when you have bad tenant synergy, it equates to low foot traffic and unhappy tenants. A multi-tenant retail center's success isn't just about getting to 100% occupancy and being fully leased. More importantly, it's about having the right tenants. When tenants don't complement each other, foot traffic remains weak, and customers don't linger or cross-shop, which is so vital in this type of property. I've seen firsthand how some strip centers slowly decline because landlords take a whoever comes along approach to leasing. There are a couple of centers I've been calling on for years where this exact scenario is playing out. In not being strategic by curating a strong tenant mix, these landlords filled vacancies with whatever tenants were willing to sign a lease without considering synergy, foot traffic patterns, or long-term stability. Over the course of time, the centers lost their identity, customer traffic dropped, and turnover is a constant issue. So instead of a thriving synergistic retail destination, these properties struggle with higher vacancy rates compared to others in the submarket, underperforming tenants, and a declining reputation in the market, all because the owners didn't take a strategic approach to leasing. This is why tenant mix matters. A well-planned lineup of complementary businesses makes or breaks a retail center's long-term success. Landlords should be assessing their current tenant mix and also identify gaps by conducting a tenant audit to see what's working and what isn't. Also, identifying missing categories that could drive foot traffic like fitness, medical, and other experiential retail. Landlords should also be careful of leasing to random businesses, but rather looking for tenants that create synergy. For example, say you have a fitness studio like Pilates or yoga. You understand it pairs well with health and a well-being cafe, or a hair salon and maybe a chiropractor, which all work together, creating natural cross-shopping. Landlords should also be proactively replacing weak tenants with stronger, more relevant uses. Under current market conditions with low supply and high demand, it's an ideal time to do this. So if certain tenants aren't performing or deciding to renew, take advantage of the opportunity and reposition those spaces to fit market demand. By focusing on the right tenants rather than just any tenants, landlords can restore foot traffic, increase property value, and create a center that thrives into the horizon instead of just getting by. Mistake number 3, failing to maintain capital reserves. One of the biggest mistakes I've seen lately is owners not setting aside capital reserves or having a proactive plan to manage long-term property maintenance costs. Instead of planning ahead, many owners wait until something breaks, leaks, or deteriorates before addressing it, often leading to financial strain, rushed decisions, and expensive fixes that could have been prevented with proper reserves. So what are capital reserves? It's fundamentally money that is set aside for major property expenses like roof replacements, HVAC repairs, parking lot resurfacing, and other exterior upgrades. These are predictable long-term costs that every strip center owner will face, but many don't plan for and they think about it only when it is too late. I know an owner who purchased a brand new retail center from a developer years ago. At the time, it was a turnkey investment, high-quality property, fully leased with long-term contracts from well-established creditworthy tenants. He loved the deal. The center provided consistent cash flow, and he relied on the rental income for a good portion of his personal livelihood. For years, everything worked as expected. Rents came in, the property required minimal attention, and it seemed like a perfect passive investment. But here's where the problem started. He never set aside capital reserves. Since the property was new and the leases were strong, he didn't see a need to put money aside for future repairs or tenant turnover. Instead, he enjoyed the cash flow, reinvesting in other areas, and using the income to support his lifestyle. Fast forward 15 years, and the reality of owning a long-term real estate asset in Texas caught up with him. The parking lot requires a full resurfacing, a 6-figure expense. A couple of HVAC units needed replacement. The facade and signage were outdated, making the center less competitive, not to mention needing a fresh coat of paint. And to make matters worse, one of his key long-term tenants left, which is requiring a costly tenant improvement package to attract a quality, comparable replacement. Without reserves set aside, he has to scramble for funds instead of handling these expenses stress-free. He's now forced to dip into personal finances or consider borrowing at higher interest rates, cutting into and disturbing the life he is accustomed to. If he had just simply set aside 5 to 10% of rental income for capital reserves, he would have been prepared for what are inevitable costs without disrupting his cash flow. A fully leased property today doesn't mean you won't face major capital expenses tomorrow. A long-term real estate investment isn't just about cash flow, it's about protecting that cash flow over time. And this is why every strip center owner needs a proactive capital reserve plan. Because eventually, maintenance, repairs, and tenant turnover will happen, and it's always better to be prepared than to be caught off guard. At the end of the day, owning a strip center isn't just about collecting rent and keeping it leased. It's about being intentional with how you operate, how you position the asset, and how you plan for the future. What we covered today are just a few of the key mistakes I've seen strip center owners make, mistakes that quietly eat away at cash flow, property value, and long-term stability. Not keeping up with market rents leads to lost income and weaker valuations. Filling vacancies without a strategic tenant mix results in lower foot traffic and higher turnover. And failing to set aside capital reserves leaves owners exposed when inevitable repairs and expenses arise. What's important to understand is that these are all preventable issues. They just require a more proactive and informed approach. Whether it's regular rent evaluations, curating a stronger tenant mix, or setting aside reserves for long-term expenses, the best strip center owners are always planning ahead, not reacting when it's too late. If you own a retail property, take a step back and ask yourself, are you running it like a long-term investment or just hoping things continue to work out? Because the owners who succeed in this business aren't the ones who get lucky. They're the ones who stay ahead of the curve. That's it for today, so I hope this gave you something to think about, and I'll catch you in the next one. Take care.